Welcome to Section 2 of the ASC 225 Income Statement Training Series. In the previous section, we built the framework, the standards, the formats, the core components. Now we fill in the top half of that statement. Revenue, cost of goods sold, and gross profit are where the story of a business begins, and where some of the most important and most litigated accounting judgments live. By the end of this section, you will be able to explain how revenue is recognized and presented under a SC 606. You will know when revenue must be shown gross versus net, one of the most common SEC comment letter topics. You will be able to identify what belongs in cost of goods sold, calculate gross profit and gross margin, and know what a significant gross margin variance signals during an audit. Revenue sits at the very top of the income statement, and a SC 606 is the standard that determines when you can put a number there. The five-step model requires you to identify the contract, identify the performance obligations in it, determine the transaction price, allocate that price to the obligations, and then recognize revenue when each obligation is satisfied. Here is the key discipline. You can only recognize variable consideration, think bonuses, rebates, or royalties, to the extent it is probable that you will not have to reverse a significant portion later. Overconfidence here is an audit risk. This is where things get interesting, and where errors are most visible to regulators. Whether revenue is presented gross or net depends entirely on one question. Is this entity the principal or the agent? A principal controls the goods or services before they are delivered to the customer, takes on the risks, and presents revenue gross. An agent simply arranges the transaction on behalf of someone else and presents only the net commission or fee. The problem with getting this wrong is that it inflates both revenue and cost of goods sold by equal amounts, making the business look bigger than it is. This is the most common topic in SEC comment letters on revenue. Document your analysis every time. Cost of goods sold represents everything it costs to produce what you actually sold this period. The three core components are direct materials, direct labor and manufacturing overhead, factory-level costs that get absorbed into inventory, and then flow to COGS when the goods are sold. Two additional items often trip people up. First, inventory write-downs to the lower of cost or net realizable value. These go into COGS or are separately disclosed if material. Second, inbound freight, the cost of getting raw materials to your factory, is typically capitalized into inventory, not expensed immediately, and therefore flows through COGS when those goods are eventually sold. Not every company sells physical goods, so what does cost of goods sold look like for a service business? The label changes. You will see cost of services or cost of revenues, but the principle is identical. These are the direct costs of delivering the service to the customer. For a professional services firm, that means the direct compensation and benefits of the people doing the actual work. What it does not include is the overhead of running the firm, rent, IT systems, executive salaries. Those belong in operating expenses. Getting that line right is critical because it determines the gross margin that analysts use to benchmark the business. Gross profit is one of the cleanest metrics on the income statement. It is simply revenue minus cost of goods sold. Express that as a percentage of revenue and you get the gross margin, a measure of how efficiently the business produces its product or service, and how much pricing power it has in the market. What makes gross margin particularly useful is what it excludes: overhead, interest, taxes. Strip all of that away, and you have a number you can compare year over year, and across competitors, without interference from how the business is financed or taxed. Here is something every team member should internalize. Gross margin is not just a reporting metric. It is one of your most powerful audit tools. When gross margin declines significantly without a clear explanation, something is wrong. It could be inventory that has been overstated. It could be revenue that was recognized too early and should have been deferred. It could be costs that were missed or misclassified. PNJ Group's standard is to investigate and document any gross margin variance exceeding 3 to 5 percentage points compared to the prior period, not just in aggregate, but broken down by product or segment where possible. Do not issue the statements until you have an answer. Here are the key points from this section. Revenue is recognized under a ASC 606's 5-step model when performance obligations are satisfied. Gross versus net presentation depends on whether the entity is a principal or an agent. This distinction requires documented analysis every time. COGS captures direct materials, direct labor, manufacturing overhead, inventory write-downs, and inbound freight. Gross profit is revenue minus COGS, and the gross margin percentage is one of your most useful analytical tools. Any unexplained variance of 3 to 5 percentage points triggers an investigation. Next, we move down the income statement to operating expenses, the period costs of running the business. Thank you for completing this section on revenue, COGS, and gross profit.